The total number of people receiving benefits is going up, in spite of the weekly numbers looking somewhat better. Tomorrow, the jobs number for July will be in focus, and the range is all over the place. I've seen all kinds of crazy numbers, but the latest band is between 600,000 jobs lost net in the month. And the high side was a gain of 3.2 million. So that's the current consensus reading and the bandwidth that we need to work between. Where it ends up, we'll find out tomorrow morning. But if it ends up that there were net jobs lost, I think the markets are going to take a little bit of a breather in here and maybe sell off a little bit, at least see some profit taking. And of course, if we get an outlier number, a kind of a fat tail number down considerably, in other words, more jobs lost than anyone imagined, then I think we're going to be in for a bit of a rough ride tomorrow. The problem with the jobs to the upside is it a trend, and will it continue, and how are markets going to read that? For the most part, they'll read that as a positive. Anything to the upside will be a positive. If it's over, I would guess maybe 1.5 million to 2 million. 3 million is what the market would love to see. 3 million jobs created in July would just be absolutely fantastic, and the markets probably take off on that. At this point, the good news is bad news. The bad news is goodness. The news stuff is kind of a little bit to the sideline for the most part, because really now the news is the news. It's not that bad news is good news in the days when, if things were bad, it was good for the market because the expectation was that the Fed would lower rates. We're already there. So bad news is not good for the market right now because the Fed can't lower rates anymore. Technically, of course, they can. Technically, we can go to negative. The Fed has said they don't want to go negative, and we'll hold them at their word there. That doesn't mean that rates can't or won't go negative. And I'm talking about the 2-year and the 10-year. Entirely possible. And the way things are going, if we get a serious correction in the stock market, if we get increasingly deteriorating economic news, which we're not seeing, then yes, I think there would be a flood of money into safe haven treasuries, and that could drive yields down into negative territory. So we're not there yet. In fact, the opposite seems to be happening. We seem to be managing our way out of the recession. So far, so good. And again, tomorrow we'll see how many jobs were hopefully created in the month of July. It doesn't help, obviously, when a lot of analysts are trying to look at what we're talking about, high speed analytics. And by high speed, we're talking about people now watching how many people are driving and how far they're driving, the kind of metrics that we can get from Google and elsewhere, these fast moving metrics that people say this is more a real time understanding of how the economy is going. The day-to-day consumption of gasoline, miles driven, things like that. These are this high frequency type metrics that a lot of analysts are trying to gear down to keep an eye on, as opposed to the lagging numbers that we get out of BLS, Bureau of Labor Statistics, and Commerce Department, and all of the other agencies that provide that information. So we'll see tomorrow what happens. But right now, the market is doing a lot of nothing, probably just sitting on its heels, waiting to see what happens tomorrow. So tomorrow could be a big day for the market, one way or the other. The betting is, again, more to the upside, that we will see job increases in July, and that should bode well for the market. If the consensus, by the way, is 1.5, a gain of 1.5 million jobs for July. That's the consensus. That's the middle line consensus. The range, again, a loss of 600,000 to 3.2 million jobs created in July. The medium is right at 1.5 million jobs created in July. So that's the number everyone's going to be watching. Gold is certainly making tracks higher. Silver is following it. We talked the other day about an SLV trade that we had on one of my services, the 10X service. We actually were stopped out of that with a very small loss. Something for everyone to consider is when you're looking to put a stop in on an options position, because we had anticipated a pullback in silver to fill some of the gaps that we looked at in the last couple of days on our shared screen here when we looked at SLV graphically, which didn't happen. Instead, silver SLV has been stronger than gold in terms of percentage gains, considerably so, and has been gapping higher. So what we did when we put on our SLV trade, FYI, this is for all of you to consider doing because it makes a lot of sense. Instead of putting a stop down on the options, which if you kind of want to make it tight so you don't really lose that much, there's a good chance you're going to get hit very quickly, very easily, and very often just in time to see the price of the underlying turnaround and your options turn into positive territory, and you're going to leave a lot of money on the table. I don't like to put stop orders down on options. They're just too easily manipulated. So what we do is we'll put a stop down based on the underlying price moving in a particular direction, a particular percentage, or just to whatever the mark is that we have. In the case of SLV, we had a stop. We had instructions to sell the SLV puts that we got into if SLV got to 2350. And when it got to 2350, we sold our puts for a small loss. So again, very digestible when you do it that way. The idea is not to put the order down on the exchanges with the options because they will get hit. The idea is like really just give your options some room to move. You got to give the underlying some room to move. And the way to do that best is to use a stop based on what the actual underlying instrument is doing. So that's what we did there. We got out when SLV got to 2350. And again, fortunately, we had that stop in place. And yes, we took a loss, but it was de minimis in terms of what we had at risk, which wasn't a whole lot, but don't like to lose more than you have to, and don't like to be on the wrong side of the trade. But of course, that happens because this is trading. Got a couple of questions I want to hit real quick, and then I want to look at some of the charts that I wanted us to look at on Tuesday that we can catch up with today. So Craig is asking, shouldn't the miners be moving more? The miners, yes, they should be moving a bit more, but they've also moved quite a bit, Craig. And I think that they maybe were the move is a little bit overdone. And for the most part, what's going to happen is we're going to see the underlyings moving and the miners now start to catch up because the miners actually led gold, lead, silver, lead minerals, and et cetera, higher. And also you were looking at some of the miners now facing like, well, not only stock-wise have they gone too far, too fast, had a great run, time to take some profits, but we're looking at also some of the larger miners and what's going on with the larger miners. That's impacting the miners today. And the big news there is Glencore, one of the biggest miners in the world, cut their dividend. So when investors look at the mining space and they look at the biggest player in the mining space cutting its dividend, okay, maybe things aren't so hot in the mining. You would think they'd be hot because gold is hot, silver is hot, and if we're going to turn around, the cyclicals are going to be hot, which include the miners and the metals. But when you see someone like Glencore cut their dividends, then maybe the bloom is off the rose for a little while in terms of the miners. And that's probably why the miners have this pause in here. But I think they're going to continue, as long as gold and silver continue to climb, eventually the miners are going to get back up on that train and continue higher. So that's really what's happening right now. And you can blame Glencore for that. Sebastian, Roku. Let's have a quick look at Roku. Roku had some pretty good numbers. I think their numbers kind of hit it out of the park. But at the end of the day, the market wants more. And what's happening is, okay, great. You had great numbers, but that's in the past. And if we were coming out of this pandemic and people coming out of their houses, if we are opening up the economy and people are going to get out, it's the same story with Netflix. Are people going to be signing up for Roku? Are people going to be spending the billions of hours? I forget the number. There was some number on Roku's on the hours watched. It was just staggering. But that's why we're seeing the sell down today. It's the numbers were good, but is that the high point? Investors are looking at that as it's okay. If you look at the stock, and we will look at that graphically, it's had a really good move, but it's sort of flattened out a little bit up here. People waiting, investors waiting for the earnings to come out. Then it's a question of what is the interpretation of those earnings? Is there more to come, or is that it? Have we just seen the best Roku has to offer? If the pandemic crisis, which moved so many stocks, is abating in any sense, then some of these companies that have profited handsomely in terms of their business and their stocks could have plateaued. And that's the feeling that, okay, Roku, maybe that's it. So time to take some profits. And we'll look at that. I mean, you look at the move, we'll look at it graphically. It makes perfect sense right down to where Roku is today. And it can go a little bit lower. We'll take a look at it. The lows of the day. It was pretty close to the lows of the day now, but you'll see graphically that it makes sense. And that was always, and there's a bit of a support level the stock is approaching right now. It's actually fairly good support, and we'll look at that and see if it can hold there. And for those of you that own Roku, this will be a level that you want to watch. So I'm putting Roku down as one of the stocks we're going to take a look at graphically for support. Shelley's asking, do you have a specific percentage as a mental stop with your stocks? Yes, you answered your own question. It does vary, Shelley. It varies based on a lot of things. And there is no rule of thumb. I suppose if I was going to create a rule of thumb, it would be a couple of things. It would be where support might be in the underlying stock. So if I have a long position in the stock, or if I have a long position in terms of owning calls, and I want to look at the stock, the underlying stock, for where I might exit, I will look at support. And if the stock comes down and breaks that support level, the near support, then I will probably want to sell my calls and maybe my stock. But certainly when it comes to calls, and you've got a tight window vis-a-vis your expiration, you've got a month or less, that's very tight, and or 2 months, 3 months is obviously much better. You got a little more room to operate. I still will look at the underlying stock and decide when I want to exit based on the underlying stock not performing the way I expect it to. The closer I get, the closer you get to expiration, the tighter you want to keep that, because you're initially eating up time premium on the money you spent for the calls that you bought. Same obviously is true for the puts. If you're expecting a stock to go down and it's not moving, it's holding, the put premium that you paid is deteriorating every single day. So as you get closer to that expiration, I look at the stock and I say, well, at that point, I'm going to tighten up my expectations for the movement of that stock, because I have less time for the stock to move. And that's pretty much how I do it. But there are other things involved as far as puts and calls when I'm using the underlying stock. But for the most part, it's really about where support or resistance might be, because the other things get a little more technical, but suffice it to say, you can never go wrong by having a simple methodology by which you conduct your trading and or strategizing of getting in and getting out of position. So for me, support and resistance is primary, and that's my go-to for the most part. Let's see, Peter. Okay, 25% since you bought it. SYNA. Okay, let's take a look at SYNA. I love it when you guys tell me you're killing it on some stocks. So yeah, great. Synaptics, SYNA, everyone having a really lovely day, up 8.3%. It's had a great move. This is something that we like. and have talked about. So good for you, Peter. Just great play. This is the kind of stock that people should have really been watching if anyone brought it to your attention, because it didn't really get hit that hard. It certainly took a tumble like almost every single stock did, through March, but it didn't really get hammered, considering where it had come from and how quickly it could have gotten beaten back down to where it started the year or a year ago. It held up pretty well. Yes, it took a hit, but it gathered itself very quickly and has been on a steady ascent since. So we'll take a look at Synaptics too, just so everyone can share what we're looking at and share Peter's good fortune. And you're up nicely on that. Congratulations. Sebastian, I think you're looking at MasterCard there. So we'll take a look at MasterCard, symbol MA, everyone, down just a tiny bit today. We'll look at that too. These stocks are great. I don't love them anymore. The dividend yield isn't appealing enough for me, and they've had their moves. There are some competitors in the fintech space that I think are going to start to make ground and pick up ground on MasterCard and Visa. So they've had a heck of a run, and this MasterCard has certainly had a nice run back off of its lows for sure. If you stayed with it, you'd be happy to see it come back. But it's stalled out here, and Visa stalled out too. We'll take a look at both of those. Again, they're both great, and I think they're going to continue to do well. In terms of my capital allocation, I would look for other stocks that I think have greater growth potential and greater stock price appreciation potential than MasterCard or Visa. That's just how I feel about those two. It doesn't mean I wouldn't own them or continue to own them if I did have a position in them. But you look at something like PayPal and the way it's performed relative, for example, to Visa or MasterCard, and you would be probably a little short-sighted to not look at PayPal and not look at maybe taking some of your capital out of Visa and or MasterCard and applying some of that to PayPal, if not, the bulk of it. So we'll take a look at those and look at PayPal too. Why? Because PayPal is one of those alternatives that, especially in the new age economy, gets oftentimes a really strong look, and especially when things get a little, shall we say, shaken up in terms of the old way of doing things and the new way of doing things. Companies like PayPal sort of come up, and people say, well, wait a second, why aren't more people adopting and using? And they will. And so you get that narrative, and that obviously moves the stock. So we'll take a look at those. Nat Gas. Michael's asking about the Nat Gas bump. Also, a month ago, wonder if Monday, Wednesday, Friday trades have any trend. If yes, it is cyclical. Love your shirts. Thank you. You know what? I haven't found, Michael, the Monday, Wednesday, Friday trades have any trend. I haven't. I've looked at that, not extensively, not done years of analysis. I'll just look at it over the course of a bunch of stocks and try and take a look and see if there's anything, and I mean a range of stocks, different industries, and see if there's anything to trends like that. There's nothing that I've noticed. Obviously, I've noticed things like, from 9:30 to 10, maybe as much as 10:30. You notice the volume there. You notice the type of trades there. I notice what happens around midday. I notice what happens around 2 o'clock, and certainly 3 and into the close. So there are certainly trends there that you can make assumptions about, whether it's retail coming in the morning and institutions later in the afternoon, and what happens in the middle of the day. You can make assumptions about that, and I wouldn't trade off of those. I use that maybe as entry and exit ideas, like, okay, maybe I want to wait till the afternoon to get out if I like something and the price seems to be trending up. If I think the market's going up, I'll wait till the afternoon to see if there's a rush at the end of the day to bid up stocks going into the next day, especially if there's earnings coming up and things like that. So I will use those kind of things. The Monday, Wednesday, Friday thing, haven't really seen anything to it. If you have any reports or any research that you've come across, certainly love for you to share it with us, because I would certainly like to see it, and I'll share it with everybody else if you have anything. So thanks for that. Nat gas, nat gas is it's the energy sector has been trying to bounce, as far as WTI, as far as oil goes. It's holding up. Is it on a tear? No, but it's holding up, and I think nat gas is going to continue to hold up. It's had a nice little run. I don't know that the bulk of that run is over. I will say if nat gas keeps going up, we might want to start taking a look at some coal stocks, because if nat gas goes up, coal is going to look more attractive. And I know that a lot of folks don't particularly like coal in terms of, and just generally speaking, because that's the trend has been away from coal. But we have to look at what power plants are able to fire off of, and almost all of them that fire off natural gas can fire off coal. So if natural gas is going to get a little bit pricey, they're going to switch back to coal. Okay. Plain and simple. So we'll take a, if nat gas continues up, I'm going to come up with some coal stock ideas for us. So we'll take a look at that next couple of days. And so I hope I answered that there. Shelley's asking, thanks, I was actually thinking more about long-term stocks. Long-term stocks, Shelley, in terms of I'm not sure. If you be more specific, Sally, if you could, on what you want me to address as far as stops on long term, because just let me know. I want to make sure I answer your question succinctly. Sebastian, closed IMMU option yesterday with a good gain. Thank you. You're welcome. Thanks for sharing that. And I'd love to see good gains. Again, if you guys have good gains, let us know. It's fun to share it. And as I've said, really want to know, everybody's got good ideas. There's so many ideas come from so many different places, and your ideas are just as valid as everybody else's. And if you share them with us, it'll be fun for all of us. I know it'll especially be fun for me, because I really appreciate you guys sharing your ideas. It's a two-way street. Immunomedics, yeah. I mean, so did you take your profit today because the stock's down a little bit? If you did, good for you, but had a really nice ride there. So congrats on that. Shelley, okay, you want to know about stops. Longer term, let me say this about that. Long-term positions, really core portfolio positions, I don't use stops at all. The only reason I'll sell out of a core position, and for me, core positions, I don't have more than ever that 15 stocks in my long-term portfolio. It's not really buy and hold, because I don't believe in buy and hold, but I'll get to that in a second, because that'll address your idea of stops. You don't need more than 15 stocks. And 15 stocks is almost pushing it. And if you're well diversified in those 15, that's one thing. You can be. Do you need to be really, 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 really well diversified? No, because if you're really that good at diversifying with 15 stocks, you're going to be essentially indexed. It's just a question of, in each industry, do you have the right stock? If you do, then okay, that's something else. That's often hard to do across several industries, to pick the best stocks. If you can do that, then you don't need to do anything and be diversified. I don't mind concentrating my portfolios. I don't mind having 3 or 4 stocks even in the same industry or similar, just because maybe they have different qualities. There's different things that they do within the industry that I like. So I don't mind concentration. You want concentration when things are going your way. When the industry is just hitting it, out of the park, like tech, for example, you want to be concentrated in tech. There's no reason not to be. And anyone tells you that's incorrect, you tell them, no, they're incorrect. You want to be concentrated. The biggest money in the history of Wall Street has always been made on concentrated bets. Always. It's never made by people who are widely diversified. It just doesn't work that way. So you want to make money, you can be a little concentrated, just don't be overly concentrated. As far as those long-term holdings, as far as stops, I don't really consider stops. If I am going to consider stops is because I hate the market and I'm afraid that we're going to see some dramatic selling and leading to a correction, leading to a bear market, in which case then if I feel that way, I will then immediately start to look at where I want to get out of my positions. And at that time, I will consider stops. But for the most part, we're still in the bull market. Yes, we had an ugly correction. We actually hit a bear market, but we're now back into bull market territory. So we're in the bull market. So I don't want to consider getting out of core positions. I want them to continue to go higher and longer, and they can go again. I have said, I think it's now 3 years ago, I said that the market would double in 5 years. So other than this interruption, which we're making it back up, I'm on target. No, that was a bold prediction. I made that on a couple of television shows, and the Stuart Varney, for one, balked at that and said, "Are you saying that the stock market is going to double in 5 years?" And the answer was yes. And I gave my reasoning and metrics, et cetera. And that hasn't changed. We have this pandemic, we have now a recession, and we have this interruption. But right now, we see the stock market is moving back up. So core positions that you're happy with, that are going in the direction you want, why put stops down? Because if you get out of them, are you going to get back in? Right? If you have a rule of thumb, and I have a rule of thumb, if I'm going to put stops down and I love the position, for whatever reason I put the stops down, I get stopped out, it's usually a couple dollars that the stock goes back up above where I got stopped out, I will get back in. So yeah, you give up a little, you give up a few dollars, but you're at least back in the position. The problem is if you put stops in and you get taken out, granted, you may have a great profit, great, but if you don't get back in, that's a problem in the bull market. So I don't put stops down. I put stops on all my trading positions. And for the most part, I've told you this, they're mental stops. I don't put stops down unless I'm going out, unless I'm not around, I'm not watching, then I'll put stops down. The rest of the time, I'm watching and I know what I'm watching for, and I'll get out accordingly. But long-term positions, I don't like putting stops down. I just don't like doing it because I don't want to be out of positions that I love. We know they're going to fluctuate. Just deal with it. You're welcome, Shelley. Peter, ELY, slow but steady rise. Still room on the upside? Let's take a look. I think there's a lot of room on the upside on a lot of things, Peter, simply because the market, we're in a bull market. And we got TINA. There is no alternative. Rates, and one of the things that is concerning me, that is disconcerting, is as the market has been moving higher, and NASDAQ has certainly just been leading the pack, we're about 2.5% from all-time highs in the S&P, a little less than that now after yesterday's rise, so maybe closer to 2%. The Dow's got probably about 8.5% to get back to its all-time highs. The Nasdaq is making new highs all the time. So we're in bull market mode and we're going higher. There is no alternative because yields are just terribly low, and frankly, the spreads. Credit spreads have compressed to the point where it's almost frightening. The amount of risk you're taking now buying junk bonds over the risk-free rate of return on an equivalent maturity treasury, let's say, you're not getting paid for the risk you're taking. So why are investors buying that? Because the Federal Reserve is backstopping the bond market. So investors are, with the Fed behind them, are willing to buy junk. And by buying junk, they're compressing the spread between the price spread between junk or corporates and risk-free treasuries. So that compression of spreads is bullish, except there's also sometimes a reason to get nervous when something like that, which is bullish, happens. It is It's because the markets are manipulated, because the Federal Reserve is backstop, because the Federal Reserve said they're even going to buy credit ETFs, JNK and HYG, for example. So that's why those spreads have compressed. That's why junk bonds have done well. So where am I going with this? There is no real worthwhile yield there. The trade has already happened in junk. Okay, if you bought junk when the Fed came out and said we're going to buy credit ETFs, including JNK and HYG, then you had a really good trade. Okay, but that trade is nearing its lifespan right now. So I don't know how much more spreads are going to get compressed. So that makes the risk of getting into junk higher now than it was a couple months ago. In addition to that, we see the 10-year Treasury plumbing close to its all-time lows. If everything was clean and green, the 10-year would not be plumbing lows. The 2 years plumbing lows, all-time lows in terms of yield. So why are investors plowing money, billions of dollars, into treasuries? That's a safety play. That worries me, that investors are so nervous that they aren't putting money into the market. There is money going into the market, but not nearly as much as going into the bond market. And we know why. The Fed is backstopping the bond market. Ipso facto, if the Fed is backing corporates, it's backing the stock market. So that gives the stock market room to move higher. Your yield in terms of the appreciation you're going to get on stocks is exponentially larger than what you're going to get in a treasury yielding 0.5%, okay, or 2-year or money market fund. There are trillions of dollars in the money market. Money market funds are overflowing right now. So, you're not getting anything there. That's a positive for stocks, because at some point, and maybe it's when the S&P gets to all-time highs, maybe then investors come back off the sidelines with some of the money that's in money market funds and apply that back to the market. And there's a huge expectation that we will see some of that money come off. There's just an understanding that there's a tremendous amount of nervousness out there as equity markets have made new highs. And as we look at the recession, as we look at unemployment figures, as we look at the jobs report tomorrow, investors are nervous that this thing could all go wrong and turn around. And the rally that we've experienced off the March lows perhaps is at some point just a false hope that we are on the other side of all of the pandemic. We're on the other side of the recession and we're there. We're not there. So the market has priced that in, and a lot of investors are nervous that that's not where we really are at. So this market can go higher because of all that money in the sidelines, because there is no other alternative to the market in terms of yield. And by yield, I do mean, yes, dividends, and I also mean appreciation. You look at appreciation and dividends, wow, you're getting the dividend yield on the S&P alone dwarfs what you're going to get in treasuries. Okay. So, and again, if you're smart and you get out of the way of something happening, that you start to see the market tumble, if you get out of the way, you're going to make a heck of a lot more money. You will have booked a lot of profits, and then you get out of the way, and then you get back in. I mean, I'm talking about when we'll talk about it here. If we see that happening, if I see that happening, believe me, you'll hear about it. It's not out there right now. Is it out there somewhere on the horizon? Sure, of course it is. Just like the pandemic was out there on the horizon. Nobody could see it, but it was out there. There's always something out there. But right now, there's nothing in clear, visible sight that's going to upset this apple cart in a meaningful way. Doesn't mean it won't coalesce and happen. It just means it's not there, so don't worry about it. What does that mean? The markets have a lot of room to go higher. Okay? Plain and simple. And in other words, it's all good until it isn't. Let's see. I think I got most of your questions. I want to see if there's anything else, and I'm going to have a quick look at all of the basics. In other words, we're going to have a quick look at bonds, quick look at the benchmarks, quick look at the FANG stocks and Microsoft, and just kind of go around robin in terms of asset classes and see. One of the only one we're not going to discuss and get into retail. We're going to talk about retail a little bit tomorrow. We're going to talk retail a lot next week. I'm going to have some plays for you in some retail sectors next week. Next week's retail week, and then the week after that is going to be real estate week. So we got some really neat stuff coming up. I'm just doing a lot of research on both retail, where it's at, and on real estate, where it's at and where there may be opportunities there, plus and negative. In other words, on the buy side and on the sell side. So a lot of stuff to look forward to. Before we switch off to some charts, Peter's asking, a pot stock becoming one of the largest in the U.S. I'm up 108%, still heading up. Congratulations, CURLF. And here's the thing about pot stocks. I haven't recommended any because I don't follow it closely enough. For those of you who do, hats off to you. There's plenty of money to be made there. Long term, just I think going to be outstanding opportunities. The question is who's going to be around. But as far as you got Curaleaf Holdings, CURLF, that's all you have? CURLF, yeah, that's what you've got. Congratulations, that's had a tremendous move. Yeah, very, very nice, and looks like it's got a lot more to go, too. So, yeah, I like pot stocks. I just don't know which one to invest in because I don't follow them. But I do believe that they have a long, long way to go. And if you find the right ones, and maybe you diversify and again, use some stops to get out of ones that are falling backwards, take some profits, and maybe end up with a core group of pot stocks that are going to continue to grow. But I don't know what they are. I wish I did, because believe me, if I did, I would be loaded up on them. They're the future. I think they're going to just do exceptionally well. That's a growth market, period. Kent's asking, do you see any temporary pullback happening in gold and silver on the horizon? I thought I did, Kent, but that didn't happen. Silver has just been soaring, and partly it's because it's a lot cheaper than gold. If you look at GLD, and I'm talking about the ETFs, GLD, and I was looking at this the other day, trying to figure out why SLV was moving as quick as it was. I did a series of regression analysis on bunch of things, bunch of aspects of both gold and SLV and GLD in terms of the pricing and some other metrics. And what I came up with was it came down to volume. And it came down to the increase, the more dramatic moves in SLV were a result of the volume. And that is a reflection of the price. And that's a reflection of retail stepping in. So we've got GLD at $193, up over 1% today. We'll take a look at that graphically. Volume 12,368,000 so far today. SLV today, volume 61,265,000, up 4.81%. So we're starting to see retail jump in, and that's why SLV has gapped. It's also one of the reasons I thought if gold was going to stall, then some of the profit taking in SLV would knock it back down. That didn't happen. So again, we got out of our SLV puts, which were a play on SLV, filling some of those gaps, coming back in on some profit taking. We got out when that didn't happen, when SLV hit 2350. That was our stop out level on the underlying. So again, unfortunate that we were on the wrong side. Fortunate that we just took relatively small losses. So let's take a look at that. I'm going to see if there's any more quick questions, and then I want to just pull up some charts that we didn't get to look at on Tuesday, and just do a little round robin on the charts. So I think I've got most of your questions for now. So let's have a quick look. Let's go to the share screen, and we're just going to do a real quick run through on the merry-go-round of stocks that we want to look at. So let's go to, hopefully you are seeing this. You should be. we're looking at SLV, and you can see the gaps over here. So we had some really weird gaps all the way up here. We had big gap here. We did fill that gap, and that's sort of where we were hoping to maybe see a little bit, move down further. We didn't get to see that. That gap got filled right there. I'm talking about this gap here on the way up, got filled. I was hoping at that point that I had made a good call and that we would see a little more profit taking. That didn't happen. When we went back up, there was time to get out of the trade. We got another small gap here, another nice big gap here. This is retail buying, folks. This is just a lot of retail buying. So I'll take a look at some of the Robinhood metrics, but SLV has become a retail darling because it's cheaper than GLD, and it's a follow-on trade to the action in gold, which is getting lots of press, and SLVs and silver is getting no respect in terms of financial news coverage. But gold, everybody's talking about gold. And it's easier to understand why gold is rallying. We talked about that. We talked about debasing the monetary aggregates, increasing M2, on and on and on. We're talking about potential inflation down the road. We're talking about destruction of some currencies, including the dollar getting hit the last 3 months. Turkish lira just on the floor. So we're seeing currency issues, and that's a sign of that's a caution flag. When you start to see increased currency activity and it becomes mainstream news, then that means there's a lot of disruption globally and a lot of maneuvering in terms of investors trying to figure out where to put their money, in which country, what's a safe haven, and so on and so forth, and where they can have a decent return, where there's a good carry trade, on and on and on. So we're seeing a lot of that going on right now. And if you want to keep an eye on gold because of that, then you're looking at the right thing. Gold rising is a reflection of all that other nervousness, of all of the indecision elsewhere. And again, we talked about nervousness even in the U.S. with there's just about $1.5 trillion in money market funds sitting to this cash on the sidelines that can be applied anywhere. There's also a tremendous amount of money has gone into bond funds over the last couple of months. And if yields come down, great. Then you own some bonds in some of those ETFs, for example, you're going to see some appreciation as yield goes down and prices go up. You'll have a nice return. If that reverses and we see a backup in yield, which I don't really see immediately ahead of us, maybe by the first quarter and going into the first quarter of 2021, I'm anticipating we're going to see a pickup in inflation, and we may see yields backing up then, which could be at that point could create some kind of sell-off in the stock market and possibly even a meaningful correction. But that remains to be seen how the market reacts to some signs of inflation. So gold, look at it. I mean, there's no reason not to continue to hold GLD. If you own it, then stay with it. Again, I wouldn't even necessarily put a stop in here because I like gold so much, because the narrative is so strong and everyone's talking about it. And when you have that kind of a situation, it's unlikely you're going to see a dramatic turnaround. You could certainly see profit taking if the market turns and there's and assets that are generally viewed sometimes as not being correlated, we find out that they are correlated, then everything will go down, including gold. Why? Because a lot of investors have money in gold, and if they get margin calls, they have to sell stuff. They'll maybe have to sell their gold too. So yeah, entirely possible. But the fundamentals for gold remain solid. Gold remains a long-term hold. All right, let's go take a look at a couple different things here. Let's look at bonds. We're looking at the TLT ETF. This is the 20-year Treasury ETF. So you can see that there's that sideways channel. We're trading up to the top of that sideways channel. If we break out above that, that means prices are going up and yields are coming down. If yields are coming down, that means if we break above there, the 10-year Treasury is going to break below 0.50. It's going to, I think the record is 0.49 something. So we're getting close to a breakout there to the upside, which means yields could be coming down more. Yields coming down more is a function of one of two things. It's the Federal Reserve driving rates lower. And right now, they're not driving rates lower. They're not doing anything. If the rates go lower here, if yields fall, it's because other investors are buying treasuries. And as they buy these 10 years and the rest of the treasury maturity curve, they are driving prices up, which drives yields down. So we see yields start to fall further from here. That's investors, skittish investors, piling into treasuries. That's not a good sign, okay? Because if you're piling into a safe haven, that means you're not willing to risk your money in the stock market or elsewhere. And so what does that say? It says one of two things. Either the nervous folks are going to be right, or the nervous Nellies are going to be big losers, and the stock market's going to continue higher, and they're going to be stuck in these low-yielding bonds waiting for the other shoe to drop, which it may not. So that's a nice look at where the bond market is. And again, everyone's watching the 10-year. When that's really the go-to. You can watch the 2s and 10s and the spread between the 2s and 10s. Again, it's too complicated for most people. Don't worry, it's not a big deal if you're trading them. If you're trading a curve, it's a fun trade. But really, the thing to watch is the 10-year. The 10-year Treasury is the benchmark. It used to be the 30-year. We don't issue as many 30 years now. We stopped issuing 30-year treasuries. We're back issuing them, and we're probably going to issue longer maturities. But right now, it's the 10-year. It's all about the 10-year. And I know this is the 20-year plus, but it's a proxy for what the 10-year is doing. We're talking longer dated. Excuse me. All right, so let's have a quick look at the benchmarks. Okay. What's not to like? Let me get some water. Okay, what's not to like about the NASDAQ composite? Still well within this super steep uptrending channel, well within it, in the middle of the pack, moving higher. Got a bunch of moving averages here. The green moving average, which I've added, is 10-day. And you've got, 7-day, and you got pardon me, this brown is your 21. So you got your 7-day. I want to look at a tighter moving average. So 7 over 20. Well, a lot of people look at the 10. I like the 7 and 21. A lot of people look at 10 and 20. I prefer 7 and 21. So here's the 7-day moving average here in green. And then here you've got the 21-day, and you can see the 21-day is just straight up. There's really not a lot of volatility there. We know the blue is our 50-day moving average, and of course the red is our 200-day. So, just got a little arrow over here to remind you of that. And these are support levels all the way down. You notice there's no resistance on the way up here. There is no resistance. So what does that tell you? There's nothing ahead. There's nothing overhead. There's no potential selling coming up. There's no point where investors say, I want to take my profits. There's nothing but blue sky ahead for the NASDAQ composite. Why? Because the big tech stocks are making the money. They're making the profits. They're generating the cash. They're expanding their ecosystems, their customer bases. So all the right things. I don't see anything stopping the NASDAQ composite. Okay, so all good there. We see the NASDAQ composite breakdown. Then we have to take a look at a lot of different things to see what's going on, and have we hit a wall? and why. But until we see the Nasdaq Composite breakdown, and certainly don't see it in the near future, it's clear skies. S&P is really the one that institutions watch. Everyone's watching the Nasdaq Composite because if they know it's the representation of the tech market, but really the institutions are measured against the S&P 500. And when we get to this level up here, this dotted line, that's basically our next resistance. Our only resistance really is the all-time highs. If we get above those all-time highs, there's going to be a lot of money coming off the sidelines. Again, we got a really nice lower ascending channel line here. Here's a channel line. It's a little, it's not necessarily parallel. I could kind of redraw it to some parallel level. It's close enough for government work, but we're well within that. And we're above the 7-day. We're handsomely above all of the other moving averages. There's your 21. There's your 50. There's your 200. All looking good. We crossed the 50, the golden cross happened way back here, and we just went nowhere but higher. It took a while for that to happen, but when it did, it didn't matter. If you waited for that to happen, you still made money. But for anybody else who, back up here, when we came back up and traded up above the 200-day, that was a good enough point to get back in. Some folks got back in when we started to trade above the 50. And if you did that, then you did just as well, because if you traded, once we started to trade above the 50-day here, you had this whole run to go with. Some people waited till you get above the 200. And if you get above the 200, you're way up here, but you still made money. Okay. So there's lots of ways to do it. Frankly, getting above the 50-day short term it's a great place to enter any stock that you're looking at. You can always keep a tight stop in there if you break back down below it. But generally speaking, if you get above the 50, especially something that's been trending down like this and way below the 50, once you get above the 50, that's a signal to say, take a look at me, buy me, keep a tight stop if you're not comfortable. But that's usually it's a good move. Last but not least, the venerable Dow. We're going to take a look at which is lagging, and it's going to continue to lag even more when the Apple's 4-for-1 split occurs. S&P and Nasdaq Composite won't be affected by the split, but the Dow will, because it's price weighted. And so you can see here, we're not even. We're just only now. Here's the 50, the blue, and here's the 200, the red. You can see now, this is why the Dow has lagged. We are just now seeing the 50 get above the 200, okay? So that should be a buy signal. And if you bought when that happened, you were already up nicely. And that bodes well. We got a little bit of resistance here. We're above that. We got next tiny bit of resistance here, about 27,600, we'll call it. That shouldn't be much of a problem. If the market is strong, we'll blow through that. And then, of course, we've got the highs up here. So that'll be our last stopping point before we have blue skies ahead of us in terms of the Dow. But once again, Dow traveling up along in this channel, broken down a little bit here, got a little nervous there. If you're watching the Dow, it's like, well, wait a second, that's not good. Came down to the 50. What happens? It resurrects itself, bang, back up in the channel, moving higher. So I don't see any destruction. I don't see any cause for concern across the markets in general. And just for we talked about a couple of these stocks. We're going to hit a couple of these real quick. MasterCard, a very handsome looking move off of the lows. Just that looks great. We're coming up to meet the old highs. We're right there. So we had this cross way back here. Stock has done very well. Again, stock traded above the 50 back here. If you bought it anywhere along here, if you got shaken out, if you stayed with it, once you saw that happen, you're probably happy. And then look how it goes. Pretty easy. So I think we got a little bit more to go. Percentage wise, it's not a bad move ahead to get to the all-time highs. Visa, the same thing. very similar chart pattern, but Visa's a little flatter looking to me. It looks a little stalled out. And one of the reasons that I wouldn't be applying capital to Visa, it's like, okay, why haven't, what is this, a consolidation phase? Generally speaking, with the market being positive, you would assume it's a consolidation and then Visa should go higher. But I don't love that action. It's another reason that I wouldn't be rushing to apply my capital into Visa. PayPal, on the other hand, you got that wrong. Pretty darn good looking stock. I mean, just crazy. So again, you like Visa, you like MasterCard, you got to look at what are the alternatives in terms of the payments companies. And if you think, well, PayPal is more new age, guess you would have done a heck of a lot better in PayPal than you would have done in Visa or MasterCard if you're looking for a place to get it. And you look at PayPal, it really done a whole lot of nothing here. It got hit, which made it look a little scary. But once it got back up here above its highs, and even though you could have even picked it up way back when it got it back above its 50 or its 200, right? So if you had done that with PayPal after the dip, you would be one very happy camper right now. Okay, so this is kind of how I look at where I want to get into stuff after a big sell down. I'm looking for the trend to change, and I'm looking at the 50 and the 200 trading wise and stops wise. I'm going to look at the 7 and the 21 sometimes and just kind of see where we are. If I see momentum there, I'm not in a rush to maybe put stops down, but I'll also use that sometimes if I see those rolling over. And I think last but not least, we're going to look at Roku. And Roku taking a bit of a hit today. And that's because as good as the earnings were, is that as good as it gets is the question investors are asking themselves. And obviously had a tremendous run up. And now you see here, we got some support here. And that's the problem. So we're going to come down to that support. We're going to break that. So I keep an eye on 149 in Roku. You can go a little bit lower, 146, 49, somewhere in that range. If we get down below here, that's not healthy. So with that, I'm going to bid you all a farewell and catch you guys tomorrow. And I'll get some more of your questions tomorrow. And thanks for being with me. Kept you a little longer than I wanted to, so hopefully it was worthwhile. And I'll catch you guys tomorrow. Cheers.